Right now, investment grade spreads are fairly tight. So, things like the Australian iTraxx index, which measures a basket of Australian investment grade credits, is sub 50 basis points, or 0.5% above the cash rate. So investment grade is really not very compelling. But we do still see a lot of opportunities in just trading those long dated investment grade bonds quite actively. So, short holding periods, looking for relative value. But the greater opportunity for us at the moment is in the private debt markets. The Australian private debt market is relatively new, and there are not that many qualified investors in that space. So for investors who do have the technical capability to really analyse the opportunity there and have got a critical mass of funds to invest, we think there's some very, very good opportunities. In a world where the risk premiums are very low, so interest rates are very low, yields on bonds are low, property, the share market, etc. We're very cautious of long-dated, low-yielding risk. So we think those types of assets are very susceptible to big valuation changes if there is some sort of market disruption. Our focus has been more on the shorter dated part of the market, and in an interest rate sense, we focus more on floating rate securities. Long maturity securities are one aspect. The other aspect is, with the easy money that we're seeing at the moment, there's certainly a creep in the level of leverage out there. And so, we are very cautious about the sorts of borrowers that are susceptible to refinance risk in adverse conditions. So we don't do, for example, direct property lending. That's a specialist area that we think has a lot of risk, and we prefer to focus on corporate risk. We're also cautious of things like discretionary retail, the mining sector, those kinds of things.